Anna Simpson here at Quant Minds International in London. Joining me now is Karen Huynh, Research Analyst at Amundi. Thank you very much for joining me today.
It's my honor to be here today.
And just start by telling me, you've been studying the pricing of physical climate risk. What prompted you to study this topic specifically?
Well, what interests me to study this questions is from what I observed from the news. For example, we see news about heat waves every summer. We see news about hurricane and typhoons every falls. And those events are actually affecting millions of people around the world. And companies are no exception. So when these disasters happen, they have their facilities and workforce that are negatively impacted by these events. And think about investors who hold stocks that are highly exposed to these type of disaster. They also face sufficient financial loss in their portfolio as well. So it's interesting to see whether the markets really reflect this type of risk into the price of equity. And although there are several papers, research papers that have been studying this question, there is still some mixed evidence. And the lack of comprehensive understanding on the topic of how the markets reflect this type of risk in price that are the main motivation for us to start this project. Additionally, we are also motivated by the potential influence of investor perception of risk, and in this case, physical climate risk, into the performance of stocks.
What were the key findings of your research, and did anything surprise you?
Well, so this is joint research of Amundi and researcher from Utrecht University and University of St. Gallen. We have been looking at the way that the markets price physical climate risk. So as you know, physical climate risk usually concerns the impact of climate change on the frequency as well as the intensity of extreme climatic events such as typhoons, cyclones, floods, heat waves, which we often refer as acute physical risk. But there's also concerning the long-term shift in climate patterns, such as the increase in average temperature, sea level rise, for example, which we often refer as chronic physical risk. So in this paper, we only look at the first type of physical risk, the acute physical risk, and particularly risk related to tropical cyclones. So what we have done is we have been assessing the exposures of around 30,000 facilities located around the world. And these facilities are owned by around 1,000 companies that are operating in utilities, materials, and energy sectors. And we use simulated cyclone tracks that are based on 70 years of historical global cyclone activity, and make prediction or projections of the cyclones activity and the damages of cyclones in the year 2050. So first of all, we found that in the sample of 1,000 companies that we have, there are more than 75% of companies that have some certain level of exposure to tropical cyclones, and particularly companies that have facilities located in some regions of the world, like East and Southeast Asia, the U.S. and Central America are the one that are the most exposed to this type of risk. Secondly, and importantly, so according to standard asset pricing, we would expect that companies that are highly exposed to physical climate risk, they should compensate investors with higher returns. However, this is not what we found empirically, and this is actually a challenge to this expectation from standard asset pricing. However, and thirdly, we offer an alternative view. So we see that the realized return, stock performance, are actually influenced by investor perception of climate risk. So when there is a shift in investor concern about physical risk in, for example, it can be driven by an increase in media coverage about certain events. And in this case, it can lead investors to revise their risk assessment and leads to a drop in demands for highly exposed company. And we test this hypothesis. We use the Google Search Volume Index from Google Trends as a proxy for investor concerns. And we found that companies that are highly exposed to tropical cyclone risk actually experience lower return during periods of high concerns about this type of risk, but they also show some positive risk premium during periods of low concerns. And what surprised me the most from this result is that although the impact of climate change on the intensity and frequency of tropical cyclone activity have been known to the public, but it looks like investors haven't fully taken this information into account. So that's why when the impact of climate change actually started to materialize, there is still surprise, and therefore there is price reaction. And the explanation could be because investors have to they suffer from limited attention, so they just simply overlook the impact of climate change until it materializes. Another reason could be because investors relied more on historical data and they underweight the projections of the impact of climate change. And to be fair, in fact, the exposure to physical risk or tropical cyclone particularly still contain a lot of uncertainty, so it's not very clear yet to investors, so that's why they might just discount the risk.
So how might the integration of climate risks into investment decisions reshape financial markets?
Well, we could see a more sustainable and resilient. We could see a more stronger emphasis on sustainable and resilient investment strategy. There could be a reallocation of capital toward companies or sectors or practices that are more environmental friendly, that companies that are more prepared and equipped to adapt to mitigate the impact of climate change, or companies that can take the advantage of the opportunities of that arise when the concerns about climate change increase. So this company could benefit from lower cost of capital, while companies that are more exposed to climate risk and without any adaptation or mitigation measures with them could have to suffer a higher cost of capital. So eventually it's could lead to more investment into some sectors or practices, for example, renewable energy, sustainable infrastructure, or resilient materials. Another impact that I could see is in the future, we thanks for the development of the methodology to assess physical risk and climate risk in general, there could be more innovative and more sophisticated financial products to arrive that help mitigate climate risk. Of course, that is something that's gonna change, reshape the landscape of the investments and risk management. Of course, we already know some financial products, sustainable financial products that are there, for example, green bond, ESG, thematic funds, or certain type of derivatives. But we could hope that there could be more to come. Additionally, we could also expect more pressure from investor sides for the stricter requirements for companies' disclosure on their exposure to climate risk, but also their adaptation and mitigation measures. So that would give investors more transparent information that allow them to make a more well-informed decision.
And what developments are you expecting in the pricing of physical climate risk over the next 5 to 10 years?
Well, over the next 5 to 10 years, we could expect that the pricing of physical climate risk into prices could become more sophisticated and integrated into financial models. And that is partly thanks for the enhancement in data on exposure. So that could be the enhancement under the scope of data. So there are more companies that are covered. But it could be also about the quality of data. For example, the exposure of companies could be assessed with better accuracy thanks for the granular data. For example, the geolocations of the facilities of this company, which we know as some data provider has already started to build their data sets based on the granular data. Secondly, the development in technology and data analytics could also allow us to make better forecasts on the impact of climate change, and that could also be a very important input of the risk assessment model. And thirdly, like I mentioned earlier, the enhanced transparency and standard reporting would give investors more consistent and comparable data to allow them to make a better informed investment decision. So given all these elements, we could expect that the pricing of physical risk could become more sophisticated. Even financial institutions could start to integrate these climate risk into their valuation model as well as their risk testing framework. And importantly, we could also expect that investor concerns or public concerns in general about climate risk could grow in the future, and that could result in a more pronounced risk premium, and which could further influence investment decision. So overall, given all these developments in the next 5 to 10 years, we could expect that a more sustainable, resilient financial system where climate risk could be better reflected into prices and investment decisions.
Karen Huynh, thank you very much for joining me.
Thank you. It's my honor to be here.